The World Gold Council's Q3 report on gold demand trends is out and shows a rise of 6% year-on-year to 1,053.9 tonnes, worth a record $57.7 billion. Investment demand the main driver as investors across the globe sought wealth preservation, portfolio diversification and strong returns. Joining me now from the London Stock Exchange to discuss the outlook for gold is Director of Investment, Marcus Grubb. Marcus, many thanks indeed for joining us. Now, where is the demand going to come from next year? Will investment demand continue as the main driver?
Yes. I think we believe that investment demand will remain very strong, especially driven by demand out of Europe. As you point out, in this quarter we saw very strong investment demand, and a lot of that was from the Eurozone in bars and coins, and also half of the growth in new ETF demand, 77 tonnes, was from European demand as well, from the European listed ETF products. So unless there is a very swift resolution to the Eurozone debt crisis, we think you will see demand for investment gold remain very strong into 2012.
And just how much more investment demand do you think is out there? I mean, look at ETS, for example, inflows up 58% in the quarter. Can that number be sustained in Q4?
Yes, I mean, I think we believe it can. Obviously, ETF holdings are at a high level. We've something close to 2,300 tonnes of gold now in physical gold ETFs across the world, much of that in the United States and in Europe. But I think if you look at institutional holdings of gold and also holdings of gold within retail portfolios in people's pensions, gold holdings are still very low when you compare them to historical levels. If you go back to the 70s and the 80s, gold was a much more common asset for investors to have in their portfolios. So we do think that provided we see continued economic problems, continued debt problems in Europe, and also a sluggish picture across the OECD, coupled with high inflation and strong growth in Asia, you are going to continue to see weightings to gold and gold investment increase into 2012.
We'll come on to those debt problems in Europe in a moment, Marcus, but a number of large fund players have called time on the gold market, either predicting a price crash or massively reducing their holdings. What do you say to this?
Well, we did see some reduction of holdings in the third quarter, absolutely. Notably, you saw selling by the Paulson Fund, which has one of the largest holdings of ETFs in the world. I think it's actually the largest single holding. But I don't think that was really calling time on the gold market. Those funds remain committed to gold. There are other commentators who are calling time. That's absolutely true. But I think among the sellers, a lot of that selling was a response to the price volatility we saw in this quarter. We saw the price rise all the way up to 1921 and then fall back down to around 1550 and then rise back to 1650 at the end of September. And naturally, I think, while central banks bought at the bottom this quarter, and we saw a very big number for central bank buying, equally some investors who were long gold took profit at the top, and they also took profit to shore up losses in other parts of their portfolios, because of course it was a very volatile quarter.
Marcus, let's look at some historic parallels. I mean, why shouldn't prices repeat the rise and fall of the 1970s?
I think there's some very good reasons why that's unlikely this time. First of all is the strong demand out of Asia that wasn't present in the 70s and the 80s. If you look at India and China, the trends there are very strong. This year, Chinese demand is already ahead of the full year 2010, and few analysts seem to have picked up on that. The second point is, as well as that super cycle demand you've got from Asia, in the 70s and the 80s, you had net selling by central banks. Now, this year, we've already got about 350 tonnes of new purchasing by central banks. It's a record number. It may be 450 tonnes by the end of the year. In this quarter alone, there's 100 tonnes of central bank buying, which we can't attribute. We don't know which central banks have been doing the buying, but we know it has occurred. So that's the second reason. In the 70s and 80s, you had selling by central banks all the way to the point where Gordon Brown sold 60% of the UK's gold reserves by the end of 2002.
We remember that clearly, Marcus, but let's concentrate more on the central bank theme. Will we see this buying trend continue? For how long do you think, and who, and how much can we expect them to buy?
Absolutely, we do. I mean, our best guess would be probably another 100 tonnes or so before the end of this year, which would mean 2011 would be 450 tonnes. That's versus 76 tonnes last year, and net selling the year before and every year for 15 years before that. So we think another 100 tonnes before the end of the year. I think in terms of the central banks that are doing the buying, it is mainly those central banks that are in countries with fiscal and trade surpluses. So it's Asian central banks, Central Asian central banks, Russia, some of the STAN countries, and it's also Latin American central banks. For example, Mexico this year is 100 tonnes of the 350 we already have. So we think those emerging central banks are going to be the net buyers.
We saw the gold price hit a record in Q3, Marcus. If the Eurozone crisis continues, exactly where could that gold price go, do you think, in Q4 and beyond?
Yes, well, I think in terms of a point forecast, I can't give you a price forecast because of the regulatory status of the World Gold Council. But we do think that when you're seeing BTP to Bund spreads at 5%, you have a long-term problem in the Eurozone. Effectively, I would sum it up by saying there is no lender of last resort currently in the Eurozone. The EFSF is insufficiently funded to solve the problem, 440 billion of which 200 is already committed to Greece, Ireland and Portugal. So sooner or later there has to be a solution to the Eurozone debt problem. But that solution will involve quantitative easing of some kind in the Eurozone. Currently, as we know, Germany is holding out against that. But if you look at Spain and Italy alone, they have about 300 billion of new financings in the next 2 to 3 years where they have to come to the bond markets. And right now they're being penalised in the bond market for refinancing their debt. So sooner or later there has to be a large bailout that will solve the Eurozone debt problem. But all that will do is raise the fear of future inflation and increase the amount of liquidity available in the system. So you see gold going higher, basically? Absolutely. We think that could certainly will push gold higher. And overall, if you look at the dynamic in Asia as well, this is a metal that is in deficit, not in surplus. So we do think you will see a very strong gold market into 2012.
Great stuff. That's all we've got time for, unfortunately. My thanks to Marcus Grubb of the World Gold Council. I'm Darcy Lampton, and this is Reuters.